listening to the Agent Survival Guide podcast, a podcast for today's insurance agents. Informing, educating, empowering, improving the way you do business in an industry that's anything but static. In today's episode, we are breaking down the three main types of universal life insurance in easy-to-understand language. A quick guide to understanding universal life insurance, written by Brenda Salyer. Many agents shy away from presenting universal life products because they can be confusing to clients. But when the going gets tough, top producers get going. That being said, it is important you understand universal life products and how they work so you can present them to clients in a way that they'll understand. Our goal with this episode is to help make all of that easy. Let's start with the basics. There are three main types of universal life products: traditional, index, and guaranteed. Let's explore traditional universal life first. Traditional universal life insurance, or UL for short, sometimes referred to as adjustable life insurance, is a specific form of coverage that combines the features of term life insurance with an investment component. With a traditional UL policy, a portion of the premium is allocated to the investment component to build cash value over the life of the policy. These funds usually earn interest at a percentage rate declared by the carrier, typically monthly. The biggest advantage of a traditional UL policy is that the premiums are flexible. Policy owners can adjust the amount and frequency of their premium payments to suit their changing needs over the life of the policy. Ideally, they'd pay higher premiums during times when they're earning more or have expendable income. Then, in times of financial stress, they'd have the options of paying less or nothing at all and use the cash value of the policy to pay premiums. However, policy owners often don't pay more than the minimum required premium to maintain the policy. In this case, only a little of the premium, if anything, is allocated to the investment portion of the policy. Thus, the policy builds little cash value. As time goes on and fees increase, the policy could become underfunded and lapse if the policy owner continues to pay only the minimum premium. Generally, an illustration for a traditional UL policy will show the prospect several different premium payment options: a minimum premium, target premium, and cash accumulation premium. It is extremely important you ensure your client understands the minimum premium should only be paid when there is a financial stressor that prevents the target premium from being paid. If your client's goal is to build significant cash value in the policy, they should be paying the higher cash accumulation premium. Most illustrations will show when the policy will lapse when paying only the minimum premium, target premium, or any amount of premium in between the two. Who should buy traditional UL insurance? Typical uses for these policies are to provide for estate planning or to cover a loss of income, mortgage, or educational need for young children. When funded properly, the client can access and use the cash value of the policy for these purposes. Next, let's break down Index Universal Life, or IUL for short. This is arguably the most complex form of universal life insurance out of the three main types. It can be difficult for clients to understand how the policy works, how their funds are invested, and what returns they can expect. Like a traditional UL policy, an IUL policy includes a life insurance component and a cash value component. The biggest difference between these two types of policies is that carriers tie the cash value component of an IUL policy to the performance of one or more indexes rather than a declared interest rate. Additionally, IUL policy premiums, which are flexible, are deposited entirely into the policy's cash value component. The insurer then deducts policy charges from that account. As the account earns interest, the cash value of the policy grows. Many agents describe IUL to their client as a product that, quote, offers the upside of investing in the stock market without experiencing any of the downside, end quote. The better way to describe an IUL product to a potential client would be to say something like, this product is designed to help you realize some of the upside of investing in the stock market while protecting you from market downturns. While it's true that IUL policy owners will never lose any of their principal funds due to a decline in the chosen index, there is still a downside to these products. That comes in the form of interest rate caps and participation rates applied to these kinds of policies. Interest rate caps are common on IUL policies, and it's important to educate your clients about them. They work like this. If a carrier caps the interest on a policy at 7%, and the chosen index rises 15% during the interest crediting period, the policy owner will only receive 7% interest. The carrier retains the remaining interest. If there is a participation rate applied to the policy in addition to the cap, the client will be credited the interest up to the cap, then receive interest at the participation rate. For example, if the policy has a 7% interest rate cap and a 50% participation rate, the client will be credited interest up to the cap and then at a 3.5% rate. When preparing an illustration for a potential purchaser, many carriers' illustration software will default to the highest illustrated rate possible, sometimes showing as much as 7% to 8% returns. Consequently, the client may expect to receive these higher returns when it is unlikely that the policy will perform at the highest rate every year. We recommend agents run the illustration at a much more conservative 4% to 4.5% interest rate. This lower rate will provide the client with a more accurate idea of how the policy will perform, when it will lapse based on the premium that they are planning to pay, and what they can expect in returns. Once a client purchases an IUL policy, it's also important for the agent to review that client's policy annually. Rarely does the policy perform exactly the way the policy owner expected. During an annual review, the agent can determine if the policy owner is achieving the returns they expected, answer questions about the policy, and, if necessary, take steps to correct anything that may be amiss, such as revising the chosen indexes, increasing the premium payments, and so on. IUL's primary purpose is for cash value accumulation over the long term. In addition to providing a death benefit, it can also create a tax-free income stream later in retirement when funded properly. Lastly, the third type of life insurance we'll cover today, guaranteed universal life. Often referred to as no-lapse universal life insurance, guaranteed universal life, or GUL, is an ideal product for older clients looking for affordable life insurance coverage. GUL is comparable to term life insurance in that it will likely stay in effect for the remainder of the policy owner's life.
Most of your clients have probably had a term life insurance policy in the past or currently have a term life policy that is nearing its expiration date. These individuals should have an excellent understanding of how term life insurance works. Once the original term is up, the premiums to keep the policy in force usually grow significantly higher. GUL insurance is similar to term life insurance in that they both have guaranteed fixed premiums throughout the life of the policy. Like term life policies, GUL policies do not earn cash value. There may be a small amount of cash value in the first few policy years, but it is usually an insignificant amount. As a result, GUL policies don't have expensive management fees and can have lower premiums than traditional whole life or traditional UL. Whereas term life policies are usually in effect for a certain period of time, like 10, 20, or 30 years, GUL policies stay in effect until a specific age, such as age 90, 95, 100, 105, or older, so long as the premiums are paid. For the GUL policy to remain in effect for the remainder of the policyholder's life, it's important to select a guaranteed period that the client will likely not outlive. The most common age to select is 105 or later, as most clients are comfortable that they will not outlive their policy at this age. GUL has several distinct advantages over non-guaranteed universal life policies. One of them is that it is significantly less expensive than non-guaranteed universal life products. In addition, GUL policy premiums are guaranteed to remain fixed, even as a client's age or health changes. Since the premiums are fixed and the policy is not tied to an investment or index, there is no chance that the policy will ever be underfunded or lapse. Now, let's talk about helping your clients determine the best option for them. As you start including these products into your presentations, remember to always ask yourself, what is the client's goal? If you can't answer that question, find out the answer from your client. Then, make sure the client's goal matches the purpose of the product you present to them. Traditional universal life and index universal life can both work if building cash value is the primary intent of the client, with the death benefit coming in second. For an older client with little interest in and little time to build cash value, a guaranteed universal life product is probably most appropriate. While not for every client, universal life insurance can play an important role in meeting the needs of an agent's book of business. Yes, your clients may find these products confusing. However, with a little effort, you can educate them and put them into the right policy for them. Being an insurance agent isn't always going to be easy, but it can be extremely rewarding, especially when you don't pass the buck to someone else. Here at Ritter Insurance Marketing, we work with agents all over the country on expanding their portfolios to include universal life insurance, among other products. When you register with Ritter, you can claim a free portfolio review, and you'll also gain access to online contracting, useful sales technology, personalized support, and so much more. You can reach out to us by emailing asgpodcast@ritterim.com. We are happy to help. Thank you so much for listening. We will see you next episode. The Agent Survival Guide podcast is a production of Ritter Insurance Marketing, an integrity company. This episode was written by Brenda Salyer. Script proofing by Tina Lamoureux. Podcast design by Urban Rivera. Recording and production by me, Sarah Ruppel. Follow along with our show wherever you like to listen. Rate and review our show on Apple or Spotify.